This quarter is an inflection point for JPMorgan. The last 3 years, their efficiency went nowhere. And this quarter, efficiency is at a turning point. This is the start of a couple-year trend of better optimizing the firm. And you know there's been a lot of pressure on JPMorgan. Why don't they break up? We brought up that issue. So either prove it or lose it. And this quarter, at least, showed that JPMorgan can better optimize. We have an outperform rating. We changed our rating. We were negative on JPMorgan for 3 years. We changed, and this is the first year in a while we've been recommending it. And this quarter certainly backs that up.
Okay. What about Wells?
Wells Fargo, we've recommended as a long-term investment for a while. It's worked over several years. This quarter wasn't as strong as JPMorgan, but you have to take a look at JPMorgan and Wells Fargo. The dividend yields are over 2.5%. So I'll reverse what I said on CNBC in 1999. Then we said, take your money out of bank stocks and put it in the bank. We'd say now, take your money out of the bank and put it in bank stocks like Wells Fargo or JPMorgan.
Pharmaceutical business, people are a little concerned about that going forward. They have obviously competition in hepatitis C. There's some concerns around Remicade, which is about 15% of the company's business as it relates to some patent disputes as well as biosimilars. But certainly we see companies like Merck and Pfizer in the U.S. Benefiting from what we're seeing in immuno-oncology. AbbVie benefiting, obviously, they've been buying pharmacyclics, so that's sort of a derivative.
Not only is Europe probably being overserved by the strong euro in terms of their outlook, but we've been probably, unfortunately, unfairly knocked down just because of our bad winter, between the ports, between the weather, and just a slowdown that is seasonal versus cyclical. And I think what the U.S. stock market is starting to discount is a much stronger second half, almost opposite of what the IMF says. And the IMF's probably missing the fact that the U.S. really doesn't have that big of an impact on the export side either from currency.
And I think what's important, what he said, is the earnings estimates for the U.S. have come down so low that we're going into earnings season with very low expectations versus in Europe, very high expectations. So I think we're setting up for very good recovery in stocks near term in the U.S. as we get past tax selling season and so forth into earnings.